Thank you, Mr. Kısacık and Mr. Taymur, for sharing your insights with us. And now our next panel is titled, What Just Broke? The New Crypto Fundraising Reality in 2026. And now please welcome our panelists to the stage. Marc Johnson, Vineet Budki, Ben Lakoff, Brandon Ma, and Tobias Bauer. Please give them a warm welcome.
Hello everyone. My name is Marc Johnson. I work for PL Capital. That is the investment vehicle of Protocol Labs. You may know Protocol Labs from IPFS, Filecoin, other related projects. As our introducer just said, we are here today to talk about what just broke the new crypto fundraising reality in 2026. And a lot has changed over the past few years. Say 2-3 years ago, the fundraising route for crypto is pretty straightforward. You raise a seed round from a crypto VC, you launch a token, and the market really does the rest. But as we sit here today, that statement, every single aspect of that statement has fundamentally changed, right? The lion's share of the capital raised in the last year or 2 years has gone to AI. The majority of token launches from last year are very underwater. And the capital that is moving is flowing through different types of structures these days, whether it's liquid funds, whether it is some type of public vehicle, or maybe it's an ecosystem treasury. So today I really want to talk about what has broke. Was it the model from a fundraising perspective? Was it the token structure? Is it capital rotation? All the different intricacies in there. So maybe to start us off, we'll do a round of intros. Tell us who you are, what firm, fund, or foundation you work for, and maybe the single element that you think has fundamentally changed for fundraising in the crypto space over the past, say, 18 to 24 months.
Good afternoon, everyone. I'm Vineet from Sigma Capital. It's a fund based out of Dubai. I've done close to 300 plus investments across 3 funds. I've been in that time when, into 2020, whatever you touch goes to a 300x paid network pools. Casper launches at 1000x. I think that was the time that we all made money and then we gave it in the next cycle back. Now, the funny thing is what really broke, in my opinion, is that the structure has changed. In the end, we are going through a dot-com moment right now. What it means is when the dot-com happened, suddenly everything was valued at 100 million, pets.com, care.com, anything.com, and raise money. But then 1 year later, people ask, where is the revenue? Today, the thing has changed where people ask, okay, wow, great, Ethereum is great. We're building a layer 1. Where's the revenue? Where's the ecosystem? Where are the people on board? And that's what's changed. People are looking at these projects with a much more serious eye. And looking at the growth, there will be Googles and Facebooks of the future coming soon as well. Thank you.
Hey, everyone. Oh, man. Oh. Hey, everyone. My name is Ben Lakoff. I run Bankless Ventures. So Bankless is a media organization within crypto, and I run the VC arm. So agree with what Vineet said about what changed. And I just simply add, it went from easy mode, where everything was 100,000x, et cetera, super liquid, venture-style returns in a quarter of the time, to more of hard mode, more of it's time to show me, don't tell me about the wonderful things that you'll bring with blockchain technology.
Hi, I'm Brendan. I'm from the Arbitrum Foundation. The Arbitrum Foundation, we're the foundation behind the Arbitrum ecosystem and protocols. As of today, the largest scaling solution on top of Ethereum. We power about $14 billion of liquidity. There's about 1,000 ecosystem projects in the network. So I think we're very privileged to see it from a slightly different perspective. We look at a lot of these projects in the ecosystem, a lot of great founders that are going through this cycle and this environment. And I think what really has changed now is we're in a bear market, of course. Part of that rigor and discipline for founders building inside of that environment means that they start thinking about P&L, they start thinking about their balance sheet the way that you would expect any top CEO or founder in any other high growth industry would expect. And I think that translates into what is the product market fit that you're building? How can you communicate that to not just investors, but your partners and the broader ecosystem? And how can you use that to propel yourself towards either that next fundraising moment or the milestone that you're achieving on the business side?
I'm Tobias. We run TBV, is a venture fund based out of Singapore. Before that, we ran a different venture capital fund called Blockchain Founders Fund. Did about 200 investments across those two vehicles. And TBV more or less focused on seed stage projects now in the Web3 space, both equity and token investments. And I think, being in investment space since 2017, I think we kind of went away from the fundamentals idea of Twitter followers, likes, impressions, build a business towards the actual fundamental idea of we need to generate revenue, we need to figure out product market fit, we need to have unit economics. Like, I think we went from the high school to the grad school, which I don't necessarily think is an issue. I think it's just a different way of looking at the industry in order to generate returns as a fund. And I'm actually quite positive about this change. And it's still possible to have great returns in this industry, but it will take longer. It's not your overnight success, and I don't necessarily think it's a bad thing. It's just a different way of looking away at the industry, and it's a different way of allocating capital over a longer period of time.
Fantastic, thanks for that. The through line I think I'm hearing here is that as the industry has matured, so has our discipline and intention with allocating capital, right? We're looking for those founders, those companies where the product market fit is more established, more validated, where the founder and the team are more disciplined with how they're deploying the capital that they raise, and maybe ecosystems, for instance, are being a little more reserved with how they spend the tokens that they have associated with them. Interestingly, though, I mean, many of you, have various token allocations or have invested in token projects. I don't hear much about the structure of the token really changing or how that has potentially impacted the fundraising environment. I'd welcome any of you to say something about that, right? The years of the low float, high FDV type of structure with tokens seems to be kind of past us now, and we're looking for some of those more established companies, more established projects. So do you think that the token mechanism is still valid and the incentives were just wrong in these past few years, or there's some type of iteration that needs to occur with regard to token design? Maybe, Brendan, I'll ask you to speak on this first.
Yeah, a couple perspectives on this. I think in the past, tokens as a wrapper, I think were treated by different people for different purposes. And I think on one end of the spectrum, you definitely had a lot of teams and founders that would look at the token simply as a way to generate capital formation as early as possible. The analogy I would make is, I think if you looked at a venture-backed business in anything outside of crypto, liquidity is sort of that end goal, or it's definitely that milestone you get to once you achieve PMF, once you have some verifiable traction on board. I think the benefit, but also the curse for a lot of raises in the past, in previous cycles, is that liquidity was actually the starting gate. I think where we move to now, some of the great founders that we look at, and even as an ecosystem, the way that we think about generating growth and value across the ecosystem is, how do we ensure that you can generate value, economic value, in a way that any strong network economy can? How can you look at distributing or allocating that value in a way that prioritizes the stakeholders that matter in your ecosystem? Governance, I think, is also very important. Many things have held that back in our industry. Regulation is one of them. Also the appetite for a lot of teams to even think about governance as a premium. The way I think about it is, I actually think for the best institutional allocators that are now emerging into the space, they understand more than anything that having strong governance and accountability and the ability to report against the growth that you're achieving in the ecosystem, that's actually the difference between a token or any assets having extremely high risk versus just having high volatility. And volatility for any institutional investor is not necessarily a bad thing, as long as you have the governance behind it to know that this asset can capture that volatility over time.
very good point. And Ben, I'd like your thoughts on this as well. You know, Bankless has such a strong and well-known brand as well as such a strong community behind it. So how do you think about that from a token perspective?
Yeah, I mean, further to what Brendan said was, if you think about these companies, they're basically early stage startups, and you have a wildly fluctuating token loosely representing the value that it creates in the world. And it becomes incredibly distracting for the founders. But if used correctly as a tool for distribution, it could be very powerful, especially in the early days, bootstrapping certain incentives that you're wanting. But a key through line that we'll probably touch on many different times with this is like you have to have product market fit. You have to know what kind of areas to incent. And if this is just like an escape valve, value capture for the founder, the early team, early insiders, then it kind of defeats the purpose, and that game is changed drastically from the previous cycles as this whole ecosystem emerges. But to your question, yeah, distribution is incredibly important, building that community. This is a big part of Web3, but making sure that token captures value in that ecosystem that you're creating is super important.
Sure. And Tobias, I think you would have something to add on that. Do you have anything to say?
Yeah, I think the main thing that changed from the early days was you never really had to worry about where to list, what to do, because there was always enough action going on in order to move the price or like to get where you want it to be. I think now the venues are a lot more consolidated, and the majority of questions we get from founders is like, how do I get listed on certain exchanges? What market maker should I use? And that kind of gets you thinking to an extent where like I would almost argue that a token launch is almost entirely, discorrelated from the underlying business, right? Where it's like, one guy in the VC world said it very nicely. It was like, I only invest in founders that can build hype, right? And like, you can argue it's a good or a bad thing, right? Because hype eventually is attention, which could lead to distribution. But for the most part, it's like figuring out, okay, you have an interesting company, which is great, and you have a tokenomic structure that would sort of incentivize it. But at that stage, when you're typically launching, where most companies don't even have the entire business built, the entire mechanics built, and they feel the need to get to TGE fast. I think it's a lot around figuring out what kind of levers to pull in order to have a successful TGE. And I think that's also partly the VC's fault, to be honest, right? Because we are kind of pushing companies to launch. We are expecting returns because LP is expecting a return because now they're an LP in a crypto fund. And it kind of creates this, like, in my opinion, unsustainable idea, right, where companies are spending millions of dollars to get certain listings, and I could arguably, could argue that the money is probably spent in different areas much better, but it creates that drive that is, pressuring a lot of founders and into making decisions that are maybe not the most favorable for the underlying business, but for the chart, right? And I think is something that's probably over the long term unsustainable. If we really we're talking here about utility and we need to figure out of governance and all these things, like these are very little problems people have when they're in front TGE at that point, right? They might think about it, they probably have it planned, but it's like, I need to get to this point of the next 12 months to stay relevant, to not dip below a certain price so that my community, my investors and all the people don't lose faith, right? And I still have the capital and the attention to build and eventually get to that point that I can implement all these other features that I was supposed to do.
Absolutely.
The funny thing I'm thinking, actually, talking about the hype factor is, Elon Musk is the ultimate hype man, and he's got a multi-trillion-dollar IPO coming that has like a 5% float when they launch. So like the low float, high FTV, very, very high FTV with a multi-trillion-dollar IPO.
It exists outside of crypto.
Exactly. It's just changed.
But he has good companies.
Yeah.
It's not just like that he has some random ideas.
Right, with real utility.
Yeah,
right?
with real utility. But so he's like the ultimate thing, right? Of like, I'm super hype, I'm super famous, and I have actually great businesses. So like you could argue that's a great idea. And in crypto we had like some people that really figured out that hype model really, really well, but they didn't have much project going on. Right? Gaming was a fantastic example where like, we need 3 years to build, but our hype is now, and we have basically a trailer, right? So it's that weird timeline that we're working with, and I think that's what's eventually probably going to be a problem.
A number of really good points there. And Vineet, I wanted to get your perspective on this as well.
Before I answer what really broke or what's working, we need to first differentiate between equity and token. You know, a lot of people I ask, how are these two differentiated? I don't get answers to this. For me, equity is basically ownership of revenue. Like Binance, if you have an equity owner and it does $100 million of revenue, it goes to CZ, who's the owner. Tokens don't represent revenue. Tokens represent process ownership. What it means is, simplest format, Binance is an exchange which trades token, and the trading fee goes in BNB coins. Today, Binance does $1 billion of turnover, tokens are needed. Tomorrow, when it does 100 billion, tokens will be needed more. So token ownership is process ownership, and equity ownership is ownership of revenue. Now what happens is, when we look at the equity markets, you know, tomorrow you got an idea, you scam your mom and daddy for $50,000 and build a great presentation, go to an angel investor, raise $500,000, Series A, do $200 revenue, and continue A, B, C, and 10 years later, you have 1,000 people who have invested in you, and 10 million people who have probably used your product, and that is the day you are doing an IPO. 1,000 people are selling your share, and 10 million people are buying your share. So the buy and sell pressure manages. In crypto, it's different. You come up with an idea, do a Series A seed round in 10 days, private round in 20 days, and suddenly you have $5 million and you launch a token. I, as an investor, if I have invested at a $10 million valuation and a token opens up at a 100 million or a billion, what will I do? Sell. Is there anyone to buy? No. So how do you play this game differently? And that's where Web2 founders fail in Web3, because they come with the concepts of Web2 and try to implement it in Web3. You have to run the Ripple model. You know, Ripple started with 10 cents, went to $3, no product, no nothing, only hype, crashed in the 2017 market. They came up with the idea that we will be an equivalent of Swift network. Tokens sort of started doing well, but you know, there was no integration of process because no banks were really buying it up. But they went up a bit in the last cycle, 2021. And finally, in this cycle, they changed the narrative. You know, the pivots that a company which is on equity and hidden is happening in real time. Today, they said, if smart contracts have to be to become big, we have to match the Visa network, and only Ripple can provide that output in terms of transactions per second. And then Ripple went up to becoming $3. In this ups and downs, they continuously sold tokens and built a treasury. Today, all smart companies have treasury. Tezos has a $5 billion Bitcoin treasury. Whether they're doing anything or not, I'm not going there. I'm just talking treasury. Polkadot has a $1 billion treasury, and a lot of these companies, WorldCoin has a multi-million-dollar treasury as well. And hopefully, you know, in this 10 years with their money, they get product market fit and they get users, and these users end up being holders of their tokens. So two different markets have to be looked differently. Smart founders will keep building treasury, keep building customers, and that's what will back their token price in the future.
A lot of wisdom backed in there. And I really appreciate the historical arc of the Ripple example. Maybe to stay with you, and then we can hop around from there. Building off of that, you know, what are some of the key things that founders need to understand now and start to do for their companies to build more successful companies in the crypto space and have successful fundraisings or meet their fundraising objectives?
So, you know, founders in crypto space can always raise money in equity as well as tokens. You know, not all companies raise in token. They first need to figure out whether the token can be attributed to a process. If there's none, then you don't need to raise money. You can just do, if you are going to do an exchange, why do you need a token? Just go and raise it in equity. Haven't companies raised it up? But then the second thing is, if you're going by token, you are going to use smart Wall Street tactics to build up your treasury. Then play the game as is required. You know, if it means listing up on a top exchange like Binance and seeing to it that you get enough volume that can help you build treasury through ecosystem tokens or through your treasury tokens, do that. You know, so founders have to play that game. But in between, you know, in Web2, when I was a Web2 founder, they used to say have two founders in your team, two CEOs or whatever, one who actively raises and one who actively builds. So there should, in crypto also, you should have one guy who is actively doing Binance and everything and market making and taking your token places and building a treasury, and one who's running a team to get you traction. I don't see the second one ever. You know, if people say we are going to build a stable coin, I'll land up in Africa, there's no one working over there because Africa is not sexy enough. People are in Dubai, people are in New York, where I don't think crypto has an adoption case in global south, not in New York, where I
Sure.
get my bank to pay interest. So that's what I look at it. Hopefully people evolve.
I'll take a slightly different chance or stab at it. So perhaps a bit antagonistic since we're all VCs up here, but I'd say one thing that a founder could keep in mind when raising is, do you actually need to raise capital, especially in today's day and age with AI tools and kind of what you can do? Raising capital, just because you can raise doesn't mean you should raise. Like Vineet said, you can always find capital. There's always kind of investors looking in one way or another, but there's different methods. So if you do raise, then knowing that all investors have different expectations, timelines on the way that you're going to build. So that's one thing, is aligning expectations. And the other thing is like understanding the economics from a venture capitalist and the way that they're thinking and the way that they want your outcome when you're thinking about raising is also very important. They want super high growth. So maybe your company isn't that sort of style of company. So maybe it also doesn't, it's not even a good fit for venture capital anyways. So those would be the pieces that I'd go with.
I might take it from a different tact as well. I think there's two things we haven't discussed yet that might change a lot of the playbooks for how we think about not just fundraising, but liquid token markets. And before I say those two things, I mean, one interesting observation that everyone should keep in the back of their minds is even the concept of, everyone up on stage is effectively a VC, right? How important or how relevant are VCs when we think about publicly listed markets outside of crypto, right? Not very relevant at all, or relevant to the point that they become public. And I think there's two things happening now. One of them is clarity in the US. That itself will be a very interesting and I think important catalyst, my personal opinion, because it changes the dynamic longer term of who are the active participants with tokens. When I was in TradFi, we would constantly talk about just how deep and how liquid traditional equity capital markets are, and in particular in the US versus the rest of the world. Once that comes into crypto or with tokens, that is something we've never seen in any other cycle. The second thing is, I think when we start thinking about what is actually emerging now with Wall Street, traditional financial firms, that now have that clarity to say we can not only allocate into tokens, subject to that regulation, but we're already testing out how do we tokenize the systems and the processes that we've been thinking and creating pilots over for the last nearly a decade. How do we start putting equities on chain? How do we start putting bonds, other types of derivatives? How do we start taking out the entire back ends of financial institutions that dwarf the size of any of the large companies that we think about in crypto today? I think as an allocator or even as a founder in that landscape, you have to be very clear on what your mental model for what should be a valuable company is. If you think that the token has to be some sort of exchange mechanism within that sort of set of transactions, that's one way to think about it. But if you also think about tokens effectively as programmable equity, being able to accrue the value from billions of dollars coming on chain, I think that's something that's happening now that we're only seeing the first innings of. We're seeing the first innings of these piped equities coming on chain. We're sort of uniquely in a position where we're working very closely with the Robinhood team that we've been very public on, building the Robinhood chain where they're putting equities amongst other assets onto the blockchain. But I think we're sort of at a very early stage where we're starting to see companies that want to face that opportunity versus those that do not necessarily think they have either the token or the infrastructure to accrue that value.
Very valid points. Tobias?
I want to echo kind of 2 points here from Ben and from Brendan. I think it's kind of become a marathon of who can raise more capital as a metric of success, right? Like I hardly hear someone talking to me like, oh, this guy invested in me, this guy invested in me, versus like I made this much revenue or I have this awesome of a team or whatever it is, right? And that's been there for a long time. It was kind of like introduced by the whole Silicon Valley idea. And I've also met a lot of founders that were deeply unhappy with the people that took on the cap table or like with the amount of equity they gave up, because you got to realize like every dollar you're going to sell to an investor is a piece of ownership less in your pocket, right? And you have a long way to go, right? So sometimes people, they are at a pre-seed round and they give up 25% of the company, and then like at a seed they're like 40%, and then like the two co-founders are not even holding majority anymore. It's not a very good position to be in at that early stage, right? Especially if you think you have like A, B, C, D, E, whatever, then go public and you still want to own a piece at the end as well. So that's number one. And then number two, I think, if you look at Hyperliquid, like you don't have to raise from VCs to be a large company, right? But obviously you have to have a great product. You have to figure out some sort of moat in order to be attractive or like to build stuff. And I do believe that just understanding like how capital is being allocated right now, like the way AI has helped founders to decrease their cost of actually starting a business, I think also positively impacts the entire venture industry. Right, but like a founder does not have to hire maybe immediately the super expensive blockchain developer or like the super expensive dev team for like hundreds of thousands of dollars, and can sort of vibe code the MVP at least to an extent that like he can sort of product market fit testing the whole thing. And so you don't immediately have to run to startups, right? Because that is a barrier of entry. You might have a great idea, but you don't know the VCs, and then like you have to figure it out, and then like a lot of people maybe just like not do it. And now I think that barrier of entry is a lot less, which is positive for potential innovation. And I think coming to your point, where like we find other ways of raising capital, right? Which might be even more interesting through communities. I mean, we're talking about the whole tokenization angle now. You have obviously the idea of launch pads in the community, right? You can argue if it worked or not, but there is other ways in order to get VC funding. Because at the end of the day, if you want to get VC funding, is you have a great story and you're a great networker, right? That's what it all comes down to in the very beginning. And then once you hit a certain stage, it's all about numbers and metrics, right? But if you nail that, everybody can raise a bit of capital. The question is, can you raise more later on? Because you eventually have to show progress over time. And if you promise a bunch of people and don't deliver, they probably won't invest in you again, right? So, but other than this, it's a very simple game, theoretically. But I don't think it's necessarily the best game for every founder, considering there's other options, and you have the help of different technologies to bring your cost down to start your innovation in the first place.
A number of valid points throughout that really resonated with me. The marginal cost of being an entrepreneur is effectively and arguably the lowest it's ever been in history due to these AI tools that we have. And Brendan, to your point, the regulatory clarity has provided a very strong signal to market participants that there is a pathway for broad adoption and integration with existing TradFi and existing financial rails. And TradFi is accepting of that, right? So a question maybe to all of you, which I think we're kind of mulling around, is a token even needed in fundraising in 2026? Or is it something that you use after, as a, say a distribution model after you've actually proven traction? Vineet?
I think after proving traction, actually your revenue or whatever you're doing or your process actually backs that up, because every time I meet up investor, they say, what backs up? What is the thing that is backing it up? In case of equity, when you're doing an IPO, definitely the traction, the revenue, the users are backing up. So ideally, it should be definitely that once you have some numbers going, something to value you up, some people who are ready to buy it up, that is in an ideal world situation. But in a real world situation, when a token is required, there might not be any such numbers, and then you have to play the game much more differently. But this is also the problem of this industry. As soon as a token launches, founder becomes a millionaire, he has his airdrop wallets, has enough money, and he loses sight of the goal and moves on to the next project. So is it needed? Yes. Is it needed at the start? Probably no.
Interesting.
Yeah, I agree with that. I mean, I'd say the answer is it depends. I mean, it's up to each founder if they think it makes sense, but echoing that probably should have product market fit, probably should fit within the ecosystem. I do think that tokens can be an elegant solution for coordination and incentivization. If used correctly, and permissionless capital formation is something that the blockchain does really well. So there is a piece within the puzzle, yes, but not for every project, not at the earliest stages, maybe. And certainly, kind of again, it totally changes the dynamic of the company, the ecosystem for the founder, so making sure that that founder and that team understands what that does to their protocol and their company and like their incentive structure and their stakeholders, etc.
Yeah, I agree. It definitely depends. I mean, there's fantastic teams that might look at a token as a great way to bootstrap incentives to get top adoption onto the platform at the beginning. That could be one credible use of the token. I think what is more important is always about the long-term orientation, whether it's token or equity, of not just the founders, but the strategy that that platform or that business has. If there is a long-term orientation, if they're trying to build something that can be multiples in size and in traction to what they have today, I think that shows up in go-to-market, that shows up in how a treasury or a balance sheet is being invested, and it also shows up in the traction that they deliver either at this fundraise or in that next fundraise. If they've said they've gone out to achieve certain milestones and they've achieved them with that long-term goal in mind, that differentiates a founder versus others.
I think it's actually a very important decision to be made, and like a lot of people take it very lightly. You know, I hear this always on calls. It's like, yeah, we're raising on equity. Maybe we're going to raise on a token as well. Don't know yet. And it's kind of like people are taking it as if it is just like something you do, right? If you launch a token, like everything changes. And it can be very bad or it can be very good and everything in between. And it's going to decide what additional capital you need, what your focus is going to be, what type of people you need to hire, what relationship you need to build, where you need to be present, where not, where you need to have relationships. It's like a whole thing. It's not just like doing this, right? A lot of people, it's like the same thing when a lot of people make the same mistake with getting a dog. It looks very cute, and then you realize, shit, now I have to take this guy out every day and do everything for the next 20 years. And that's the same thing with a token. And I think for a VC, it's very important to understand, almost essential. It's like when you invest, let's say, on the equity first, because you're in a bear market, a bull market comes and a company launches a token. They have effectively taken your money, build out a structure, and then launch a token on top of it, and you're not incentivized on the token. And if these structures are not correlated, what Vineet said in the very beginning, between process and revenue, then you end up having value accruing on the token side, but the equity is worth nothing, right? And then you get into lawsuits. Then you get into problems. And we've seen this a lot in, you know, especially in the hype of 2021, 2022, going into the bear market where companies switched around because I cannot raise on token, let's raise on equity, as if it would be a game. You know what I mean? And I think that's very bad for the industry. And I think as a you know, we always need to be ensured that like if there is a token coming out eventually, we will have allocation. And that got sort of solved with this whole, you know, like SAF plus token warrant model, but like, you know, sometimes it's not used or not recognized in a lot of things. And, you know, I think there's structural, substantial differences that need to be considered doing this. And it's not just a question like what is better or not. Like this has significant implications on basically every level of the business, especially on legal and finances.
Yeah, I really appreciate you making that point because it changes the dynamics of everything. So maybe to stay with you, Tobias, and then bring it back down. What's some concrete advice that you would tell founders that are looking to raise in the next year, 6 months or a year, right? What they should do, what they should not do, whether it's, you know, valuation, token timing, who they should raise capital from, anything or all of the above?
I think, number one, give yourself a decent amount of time, right? Because a lot of people feel pressured because I took money from this investor now and now I have to launch it in 3 months, right? And like you just will not have a good TGE in 3 months unless you are like the top OG guy, right? That has done whatever, there might be a chance. But for the most part, no. So number one, give yourself sufficient time. I wouldn't honestly be too worried about valuation because valuation is another trap that you can walk into, right? It's amazing to take money at a high valuation, but eventually you can't go bigger if you don't get the metrics, right? And then people have all these random like acquisitions where it's like, this is my best exit because I cannot raise more money. So now big companies acquiring me, so my big investor gets at least a stake in a company that goes pre-IPO, right? That's what happens a lot of times, and the acquisition is worth nothing. It's an acqui-hire, and then you work for the big company. Right. And like that's a very scary thing to do, right? Because you need money eventually, and you don't want to do a down round. So like, I would say be relaxed on the valuation. Just be careful of how much money you're actually raising, because that's a direct impact in how much ownership you're going to lose, both on token and equity, right? It's not ownership per se, but it's supply that goes out of your hand.
Sure.
And maybe the last thing is just kind of want to echo what Ben, I think, also was saying, is like choose the right investors. Like if you're not trying to be the next billion-dollar hyper-growth company, that's people need to understand. A big investor doesn't want your 5x10 return. They need you to return their entire fund. That's typically the logic a lot of venture capital funds have. So if you don't hit that, you will have an agreement where you cannot sell. Like there will be certain, clauses in an agreement where like investors do have a right to make decisions with you or on behalf of you if it doesn't fit their return model that they have done in the past. And the whole thing we can go into, but these are some of the things that I think are very important.
Absolutely. Brendan, concrete advice?
Yeah, I echo a lot of what you said, Toby. I think working with the right types of partners and just having that long-term mindset, and that applies across the board, not just to the types of investors that you want to work with, but we get the privilege of seeing an incredible amount of teams and founders that go through different parts of the cycle, and even their choice of everything from infrastructure provider to the types of marketing work that they're doing. It's just at that early stage when it feels like anyone can give you that sort of golden bullet to achieve the next thing that you want to do. It's really just being intentional and thoughtful around who are the right types of partners that you want to bring on board over the long term. The other thing I would say is I think the reality in this current market and this environment, it's just important to understand where we are at in this industry, right? We are in a bear market. I think for most founders, it is very, very difficult to raise, difficult to differentiate yourself versus others. And I think that's where thinking about your business strategy and saying to yourself, okay, if we can be very clear on where does value accrue, what does success look like for us, what are we really building towards? And I think to your point earlier, Tobias, if you're engineering towards hype, that might not be a negative thing in and of itself. It might actually be a positive thing to drive attention towards an underlying product, but that assumes there is an underlying product. So I think in this market in particular, it's more important that the business fundamentals and your strategy anchors towards something that is repeatable and that can grow longer term.
Great points. I'll just add two things. So one, just because you can fundraise doesn't mean you should, and think long term with it. And the second one, man, totally lost my train of thought there. I did have a good.
It's only one then.
Well, it could just be one.
Easy.
Yeah, I'll just leave it with that one.
That's a good one.
That's good.
Vineet?
So anyone who's fundraising right now, I have just one advice: be patient. Hope, because crypto runs in 4-year cycles. Unfortunately, we are in the 4th year where it's a downturn. Maybe Bitcoin hasn't reached the bottom. And when people are not investing in Bitcoin, chances are they will not invest in your startup because they think even the leader is not able to sustain.
Fair.
So what I advise is please be here for a longer term. We see this always during this 4th year that these rooms don't get full. Last year, if you would have been on Istanbul Blockchain Week, this room was crowded. The SUI event was full of people. But in a bear market, it's always messy. Raising capital becomes tough. But this is the time where you build relationships with the person sitting next to you, because this guy is in here for the long term. This is the time where you build a relationship with a VC and an investor, not to raise money tomorrow morning, but to show him your progress in the next 6 months and hopefully raise when the markets start bouncing back. And then build a great product and give us great returns.
Absolutely. So maybe just to close us out, quick lightning round. We got 60 seconds here. One sentence. The crypto founder who raises successfully in 2026 is the one who
ends up building great revenue and companies.
Okay.
don't get shoehorned into the big hype that's happening. So don't build a perp dex or a fintech because you think that's what VCs want. Build something unique.
The founder is resilient.
Oh, you took all the good ones, man. I'd say founders are going to raise, that are very good at storytelling.
Interesting. Nice. Well, ladies and gentlemen, you heard it here, and thank you all for participating.
Thank you.
Thanks, Mike.
Thank you.
Thanks.
Okay.
Oh, well done.